Hello and welcome everybody to the Isabel Interviewer Show. We are joined today by Joel Greenblatt, a value investor and professor at Columbia University. He is also the author of the critically acclaimed new release, The Little Book That Still Beats the Market. Welcome, Mr. Greenblatt. It's a pleasure to have you on the show.
Thank you. It's a pleasure to be here.
So, let's get right into it. Tell us what your book is all about.
Well, Isabel, as you may know, this is a follow-up to the version I wrote years ago. This book uses the same investing formula as the first, with added insight, based on how it has performed since then, and during the recession. Quite simply, my book is meant to help people learn how to invest wisely, and hopefully earn a lot of money. I try to keep it simple, so the information can be easily interpreted and understood by those without formal education in investing. I think accessibility to this information is essential to my purpose.
Sounds very interesting. Would you be willing to give an example of how you made the material understandable and identifiable with the reader?
Certainly. I've found through years of experience, more complex investing formulas can easily become convoluted and hard to truly understand for the average person. My formula is very simple, and I use the example of a young schoolboy my son witnessed buying and selling gum on the playground. This boy has proven to be quite profitable with his little business. So, I asked my son one day what he would be willing to pay to become a partner in this bubble gum selling business. I won't go into the details now, but what it essentially boils down to is my son agreed that he would not want to invest more in the business than he would potentially earn in the future. It's a simple concept that I relate to the world of stock investing. This example shows the importance of correctly valuing a company, so you don't pay too much for its future cash flows. It is the foundation of the formula I explain later in the book.
I see. So, what goes into this magic formula of yours?
In short, the formula ranks relatively large companies based on a combination of their earnings per share and return on capital. Generally, a company that operates efficiently and invests wisely is a good investment. This is not exactly groundbreaking, but it is an important principle to understand.
I know most people at home are wondering whether or not they should believe your method to the madness. Most people would say, how can anyone be successful and earn the same amount of money as the professionals that invest for a living? Especially, just from following a simple formula that your book offers.
Well, let me tell you about one of my favorite movies of all time, The Karate Kid. In the movie, the old karate master, Mr. Miyagi, is supposed to be teaching his teenage apprentice, Daniel, how to fight. The boy is new at school and was being bullied by a group of karate-trained toughs. Daniel hopes that learning karate will help him stand up to his tormentors and win the girl of his dreams. But, instead of simply teaching the kid karate, Mr. Miyagi decides to put Daniel to work, waxing cars, painting fences, and sanding floors. Finally, Daniel has enough, confronts Mr. Miyagi and asks him why he is wasting his time working instead of learning karate. So, the master has Daniel stand up and starts throwing jabs at him, while yelling, "Wax on! Wax off!" Daniel deflects each jab with a swirling motion that he learned from waxing so many cars. Then the boy continues to deflect punches and kicks from motions that he learned by working so hard. So in fact, by learning these few simple techniques, Daniel has unknowingly become a karate master. So, in comparison to this wonderful movie, I am asking my audience and readers to do a little suspending of belief. Not because what you are learning doesn't make sense, but because many people don't believe that a few simple steps in a formula can lead to great success. Throughout my book I offer statistics on the success of people who have used the formula, and clearly, the average return was greater than the market average. The user must have faith in the formula in order for it to work. Often, investment professionals are forced to focus on short-term returns due to the demands of their clients. Therefore, this formula would be of little use to them. But a person committed to the formula for the long run can and will certainly reap the benefits.
We all know the prices on the stock market fluctuate constantly. Do you address the issue of when to buy, sell, or hold stocks?
Yes, in fact I explain it based on the ideas from one of the greatest professional investors I know, Benjamin Graham. Imagine you are partners in the ownership of a business with a crazy guy named Mr. Market. Pretend that Mr. Market is subject to wild mood swings, and each day he offers to buy your share of the business, or sell you his share of the business at a particular price. He leaves the decision completely to you. You have the choice to either sell your share, buy his share, or you can do nothing, based on the price he offers. Sometimes Mr. Market will be in a good mood and offer a price much higher than the true worth of the business. On those days, it would probably make sense to sell your shares of the business. On other days, he might name a very low price for the business. In this case, it would make sense to take advantage of his crazy offer and buy the shares. Now, if the price is neither high nor low, compared to the value of the business, then you may wisely choose to do nothing. Not surprisingly, Mr. Market represents the stock market, and the prices he offers are equitable to the real-life price fluctuations of stock. Now I'm sure you are wondering how you are supposed to know if Mr. Market is offering a discount or a premium. And that's really the golden question. Unfortunately, there's no definite solution, but my formula is designed to help you value a particular business. You will buy or sell your shares based on the estimated value of the business or businesses in question. One very important thing to remember, though, is that estimate must be accompanied by a margin of safety. The margin of safety provides some room for error in your estimate of the business's value. In short, buy or sell shares only if the price is at a point below or above your margin of safety, respectively.
Could a user of your formula just select the top-ranked company and expect a very high rate of return then?
Ha ha, it's easy, but it's not that easy. A potential investor would still have to do a little bit of homework to select the right stocks. My formula is a great starting point, but there are some things that the numbers can't show. For example, a company that is in an industry that expects to become more competitive might not be the best choice, because revenues might be split up among more businesses. The top-ranked company should earn you a rate of return above the market rate of return, but nothing is for certain.
Would the homework involved in making those subjective decisions be intensive?
Not at all. Keeping up to date with financial news would do the trick, and a source like the Wall Street Journal would serve you well.
That sounds manageable. So, what kind of gains can an investor expect to earn by implementing your formula?
Based on the history of the formula, if the investor has faith and dedication, he or she could expect to earn double the market rate of return. This is a long-run projection, though. I have received plenty of emails complaining that the formula does not work. And I've found that most of those complainants have made that judgment after relatively short time periods, like a year or two. This formula is not perfect, few things in life are, and it will, and has underperformed the market in the short term. The key thing to remember, though, is that the formula will also outperform the market in the short term.
You are saying an investor should be willing and able to sit out the peaks and valleys. Is it important that an investor not need the money they are investing for current purchases or expenses?
Exactly. A long-time horizon is imperative. As I mentioned, the formula doesn't always work, but on average, it proves to be worth it. Too often, investors seek that instant gratification of large short-term gains. This is not always realistic, however, and can often get an investor in trouble. Again, those who would have stuck with the formula for the long run would have earned approximately double the market rate of return over the last few decades. This would put the earnings rate around 30%. I challenge you to find an investment out there that can boast returns at this level.
That sounds like a pretty tough challenge. Are there any other parting words you would like to share with our viewers?
I would just like to let them know that if they are interested in making their money work for them, instead of the other way around, this book is an excellent starting point. I wrote it with the intent of making investing less daunting, and as a guide for those who do not have much education or experience in investing. It is my hope that this book helps individuals achieve a better standard of living for themselves and perhaps their loved ones as well.
Very well put. This has been Joel Greenblatt, author of The Little Book That Still Beats the Market. In stores now. Thank you so much for joining us today, Mr. Greenblatt.
Thank you for having me.